Hello, everyone. This is Lucas Caceres with Level Up Financial Planning, and today I'm going to talk to you about how to offset the impact of restricted stock units and the tax impact. Not necessarily, don't take any of what I'm saying today as a recommendation, just use it more as informational and education for yourself to be aware that these types of things exist. When I work through these with my clients, it's very specific to their situation and goals and what they're trying to achieve. And so I may use this strategy, I may use a combination of strategies to help them achieve their goals in reference to employer stock and restricted stock units. In a previous video, I talked about new shares and how to offset the tax impact of those new shares. But today I'm going to be focusing more on the old shares and what I like to call tax rate arbitrage. So once you've already paid taxes on shares of restricted stock units, once they vest, and let's say you hold on to them for a few years and they've grown in value, that additional growth in value, that's all you have to pay taxes on. And that's typically going to be a preferential tax treatment for long-term capital gains. And right now, the different long-term capital gains rates are 0%, 15%, 20%. And one additional thing to be aware is if your modified adjusted gross income surpasses $200,000 for single filers or married filing jointly of $250,000, there's also additional Medicare tax of 0.9%. So that's a little bit to be aware of and just understand as well. Through this example, I'm saying that you're going to hold shares longer than that year, and then you're going to sell the amount that you feel that you wanted to target and kind of reduce either your exposure or maybe you need those funds for something else. You can then use those proceeds to fund tax-deferred accounts such as IRAs, 401ks, and HSAs. Remember, when you're contributing to those tax-deferred accounts, they're tax-deferred for a reason. They're specifically set up for either retirement or health expenses, and so they have their own parameters on when you can actually access those funds. So anything that you're going to be putting into them, make sure you're aware of those limitations and understand that you may not be able to have access to those funds in a timely manner. So in this example, we say that you sell 100 shares of XYZ at $50 a share, but really only $25 of value in each one of those shares is long-term capital gains. So that's about half of the value, $2,500 in gains. So of that $2,500, you're only taxed at, for example, we're using the highest long-term capital gain rate of 20%. So $500 in taxes, but you have $5,000 in proceeds. So even if you decided to do nothing, the tax impact is not that great. Of that $5,000, you would net out $4,500 essentially. Kind of ignoring the additional Medicare tax. We're saying maybe these people aren't in that qualification for some reason. So just kind of ignoring it for simplification purposes today. But then let's see what happens if we say we want to offset that $500 in taxes. So for this example, we'll say this individual has they fall in the 24% tax bracket. And so really you only need to contribute $2,084 of that $5,000 in order to offset that long-term capital gains tax of $500. So that's why there's that arbitrage there. If you were to contribute the $4,000 or $5,000, you'd actually end up saving more in taxes than you're paying in taxes because of that tax rate arbitrage. You're only paying 20% only on the gains and not the full value, but on any income that you defer into those tax deferred accounts, that percentage rate is on that whole value of that $5,000. So you get a lot more benefit, and you can just see the tax rates in general are just different. You get more tax deferral out of that 24% tax bracket than the 20% of the long-term capital gains. So in this example, there's actually $2,916 that are going to be free and clear that you could either contribute to a Roth account if you're eligible to do so. You can just put it in a non-retirement taxable account and diversify that out some other way. Or maybe your whole goal all along was to kind of release some of the funds out of the account to use for a vacation or some other goal that you have assigned for it, but you really didn't want to pay the $500 in taxes. So this is a way you take care of the tax implication, move a chunk of that into a retirement account or health savings account, but then you have access to the remaining funds to be able to utilize in a more accessible manner. I hope that's helpful. Feel free to reach out to me if you have any additional questions around this or need kind of one-on-one guidance. I'd love to help out with anything like that. Take care.